Hey everybody, Preston Brent here with our Trader User Group Weekly Roundup. This is for the trading week ending September 29th, 2017. So we rounded out the third quarter, and what a quarter it was. As we went into close on Friday, the S&P closed at record highs, and technology helped with those gains. The tech-heavy Nasdaq was up more than 50 basis points, 0.5%, to post its 50th record close for the year. And then, not to be outdone, the Dow posted quarterly gains of about almost just slightly under 5% for its eighth straight quarter of gains. And that's the first time that the Dow has done that since 1997. The S&P was up 4% for the quarter, and it's had 8 straight quarters of gains as well. And of course, not to be outdone, the Nasdaq gained almost 5.8% for the quarter, so it had its 5th straight positive quarter and hadn't done that since 2015. And then, of course, we're seeing support in the Dow Transports, small cap, mid cap, Russell 2,000, 3,000 hitting record highs. Folks, you can't get any more bullish than this. We've got the VIX at near 2-decade lows. I think it closed Friday around 9.5. So the other thing that I found interesting in this month of September, and just looking at the stats, the month of September is normally a volatile month. And this was one of the least volatile months, trading months, this September, in quite some time. I think the S&P on average was about 40 basis point move up or down on average for the entire time. Now, trading volume was down a little bit this September compared to last year's September trading month. We were down about 10 or 11%. But net, as I've been telling our members, and you've got to stay long right now. The markets just want to go higher. And I've got friends that are running hedge funds. I've got buddies that have been bearish really since the start of the summer. They're holding their nose and they're staying bearish, running up the shorts, running up the losses. And, eventually, of course, they're going to be right, because I guess you could probably say always a stopped clock is always right once, right? So eventually we will get that pullback. We haven't had a 3% pullback, I believe, all year long. So we're just setting records left and right. As we rounded out Q3. And we got earnings coming up in 2 weeks. And the earnings, we've had the fewest analyst revisions, downward revisions going into Q3 earnings that we've had in quite some time. So we've got strong corporate top line and bottom line growth. We've got still low inflation. We've got low interest rates. And we've seen a global growth story because we've got this synchronized global growth where we're seeing the same thing in China, Japan. In fact, the Nikkei is near 2017 highs. China's up very strong. Europe is having a strong time. Bank stocks. So I can't paint an any more bullish scenario than I just did. Now, of course, being the contrarian, we've got to be cautious because anything can set this market down. And because we haven't had a pullback in a longer duration of time, setting records, in fact, we're due for a pullback. But that doesn't mean you've got to just go all bearish right now. We'll know it. Our members will know it when the price action says we're going to go into a dip, or we're going to go into a pullback or a correction or a bear market. Each of those have different meanings. Dip meaning less than a 5% drop. Pullback 5 to 10%. Correction greater than 10% but less than 20%. And then a bear market greater than 20%. For the year, our members are doing really well in our Secret Trader. And for those of you that tune in and listen to this free weekly roundup, one of the things I'm coming out with probably in the next couple of weeks, but be on the lookout for your inbox. We're going to be starting an option master's education course, and it's going to be running probably through January, maybe even February. Every session is going to be recorded. That is a course you do not want to miss. So be on the lookout for that because it's going to be really cool for everybody. Now, what I've got on the screen here, what does that mean for the upcoming month of October? And then November and December. Well, you guys, for those of you that are stat hounds that love to just kind of see what we've done in the past decade or two, October tends to be a good month. November and December tend to be a strong quarter rounding out the year. If you look at the Stock Traders Almanac in years following a presidential election, for those of you that, again, get into the stats, the Dow has on average been up over 11 times with an average gain of 70 basis points going back almost 2 decades, going through October. But then there's a little footnote in there that says any year ending in a 7, going back quite some time, 30, 40 years, October has had a history of being very, very dangerous. Okay. Meaning we had the big, huge pullback in October 2007. 1997, we had a big pullback. And then obviously 1987, we had a crash, complete crash. So on one side of the coin, you say, hey, we're going to be going up. On the other side, you say October can also be fraught with danger. But, that's every day. So what do? We follow price action. Don't listen to the TV talking heads. I mean, sometimes they have some valid points, but you've got to watch price action. And right now the price action says you want to be bullish. I've got on the screen here the daily chart of the S&P 500 E-mini futures. And as you can see on this chart right now, on this daily, it is porpoising higher highs, higher lows. I could put the channel in here and you would see we're following this channel perfectly to the upside. You can see the MACD has not given us any downward divergences, any bearish divergences. So this suggests that in keeping with the manner in which we've been moving all the way through the summer of this year, we can expect a little bit of a pullback, or let me rephrase that, a little bit of a dip. But again, we're still on a buy the dip. And until we take out key levels, that's the way we're going to stay. Now, let me clean up the screen just a little bit and make it easier for some of you that don't follow me very closely. Well, I guess it's not going to work. I'm going to have to redo the my hotkeys on my keyboard here. But you see this purple line up here. This was my target for an extension, Fibonacci extension of prior pivot highs and pivot lows. And you could see this target is sitting right at 25.25, okay? And then the next target north of that is sitting at 25.71. These extensions of major pivot highs and pivot lows using a weekly chart are very solid. I have always held the opinion for this summer that if we just keep this process up, we're going to hit 2550 to 2600. Now, there's a lot of fiscal and monetary policies that are going to be hitting the press in Q4. From a monetary policy standpoint, we got Janet Yellen. Now, they're all on track saying they're going to hike the rates in December. In fact, the percentage odds of that happening have jumped up over 68% prior to the FOMC a couple of weeks ago. And that's primarily because of the strength of the market. Even though inflation is relatively benign, Yellen has pretty much echoed the sentiment along with many of the other voting members of the Fed board that says they want to hike the rates in December. Short of any catastrophe between now and then, that's what we can expect. Okay. Now, the markets already know that, so they've got that priced in. The markets already know, and they have priced in some balance sheet reduction, what I call Yellen's BS strategy. So that is the monetary policy coming up. The other thing that is kind of waiting out there, and it hadn't really affected the markets yet, but I promise you, you're going to see it in the press as we go into November, December timeframe, as we start to round out the year. And it may even happen sooner than that, is who Trump is going to appoint to replace Yellen, or is he going to continue to vote Yellen in? Remember, her term is up in February. And depending on who he appoints, you're going to see the price action of the market start to price in the proclivities of the Janet Yellen replacement. So we've got a number of things in Q4 that are going to be coming up monetary policy wise. But I think the biggest movers in the market right now, and I think the one that's given the market bulls, especially the Russell small cap and mid cap, their oomph, is the potential tax policy, tax cuts that the Trump administration, if they get those through, they get the repatriation of money back in. Doesn't matter whether the money's repatriated or not, but just the fact that if that stuff hits the books, you're going to see the markets in anticipation of money coming back continue to move higher. And that'll give us our 2550, 2600 price level as we go into Q4. That's not to say, or as we round out Q4, and that's not to say that we can't have a dip, and we price action comes in a little bit. But that is kind of what I'm looking at. So we're going to have a number of fiscal and monetary policies that I think are going to kind of jump into the driver's seat of this bus. And then on top of all that, we've got corporate earnings getting ready to kick off in a week or two. And all of these things make for a prescription of a potentially strong up move. Okay. Now, if Trump doesn't get his tax policies through and they falter on some of these other things, you will see the markets have a pretty good little pullback. I think it'll get over 5%. And that'll happen in Q4 regardless of what statistics and history say. Okay. So that's a little bit about where we're sitting right now. We had the strong GDP final revision of 3.1%. We've seen strong corporate growth. You can see here the E-minis closed at the highs for the day on Friday, 25.1775. Now I'll show you the Asian index. This is a tracking ETF for Asia. You can see it's near the all-time 2017 highs. Okay, so Asia is fairly strong. If we look at Vanguard's all-world index, it is near highs. I mean, look at these. I mean, it's near the 2017 highs. It looks just like the S&P. So that's done very good. Let's look at the Nikkei. The Nikkei is also near 2017 highs. So we're getting this synchronized global growth story. If we look at the Russell small cap and mid cap, it has exploded higher from the third week in August. And look at this. I mean, it's just, we had this breakout here. And generally when you have a breakout like this, we took out the prior highs in July, and then it was a very solid breakout. And we didn't even look back. We didn't. Normally when you have a breakout like this, you have a little bit of a retest. And that could serve as a support point going forward. But it's just a huge explosive breakout. Okay. If we look at the volume, you can see the volume has started to come back up from the Labor Day holidays here in the US. Volume has picked back up again. It's still down from this pullback that we experienced here in July going into August, but now volume is starting to pick back up again. So again, strong activity here. MACD, very strong activity in the MACD. And if we look at the Dow, right, and let me just pull the Dow futures up, we're near the all-time highs for Dow futures as well, okay? And then finally, if we look at the tech-heavy Nasdaq, we'll look at the Nasdaq 100. If we look at the Nasdaq 100, we're near all-time highs here too. Amazing the strength this market has shown, okay? I mean, just really strong. And then, of course, if we look at the VIX closed at 9.51, near the 2017 lows, which, by the way, are close to 2-decade lows at 8.6. When you get down at these levels, the risk of a big move, of course, is always to the upside. So for our members, we're going to look at some interesting plays, volatility plays for next week as we kick off Q4. But that's where we're sitting volatility-wise. And then, of course, if we come over and we look at the bond market, right? If we look at the bonds have sold off in anticipation of the higher rates. You can see off of the 2017 highs, which was really made here on right after September the 8th. We've crashed. and it's just pulled back a strong bit. Any upward movement here is going to be a counter trend move. The bond market looks like it wants to come down a little bit lower. Okay. And then, of course, if we look at currencies, look at the dollar. Even though it pulled back just barely on Friday, you can see here that we were below the 2016 lows. I mean, we've got this downward channel. We've been in this downward channel right here for most of January. The peak in January is really the first trading day of January, end of December, and then we've just moved down. And now all we're doing is trying to get some elevation here in the US dollar. And as I've told my members, I believe that Super Mario Draghi with the ECB and Yellen are trying to talk the euro down and the dollar up just a little bit. And I said the dollar would come up to the central region of this downsloping channel, and then it's going to have a hard time staying up here because there's just so many shorts there that want to take the dollar lower. So let's look and see where this thing flies. And then, of course, the British pound, where we've been long the pound. I've been, pounding the table on the pound. You can see this channel here. This was just, the width of this channel shows you the volatility of the pound as it's been moving higher. And the buy points of the pound moving higher or these dips lower. Okay. And then there have been 4 or 5 buy points in the pound as we've moved higher. And for our members following along with me, then we're just going to continue to ride this higher. I believe the British pound was severely overextended to the downside when it was around the $1.20, $1.23, $1.24 area. And I just said that it's just a good buy for the next several years, a longer term trade, but that's kind of what I'm looking at on the British pound. The euro, meanwhile, we were short the euro until it came down and hit one of my targets down a little bit lower here. And then as we bounced higher, I shifted gears and said that if we break out of some of these key areas here, we want to be bullish the euro. And I had forecasted the euro coming up to about $1.15, and it blew through my $1.15. It went right up to $1.16, found some support, and that's kind of where I think it's going to trade for a while, between the $1.20, $1.16 area. And then if we have a breakout, I think the more likely breakout will be to the upside, but we'll track this one for our members and see which way we want to go. Gold has done exactly what I said it would do. It came back down to the 1300 level. Okay, and you can see here, let me just get this on the screen for you. We had this huge run up here. It was aided by a very, very weak dollar, low inflation, low interest, and the belief that Yellen was not going to raise the rates. As she has started to shift gears and talk about raising the rates, even though inflation's lower, the dollar hates higher interest rate. I mean, gold hates higher interest rates, and you can see this move back down. I had said the pullback will come to the 1300 area, which is this key support area right here, and we've blown right through it. So unless we can take out 1300 and hold it on a retest, then I would say would be more short gold than long on a near-term basis. I think longer term, there's going to be ample opportunity to get long gold again, but just not right now. Same thing with silver. Silver is doing what silver always done, which is it runs these tight channels both up and down. And I think right now we're back down below this downsloping trend line, this longer downsloping trend line, as you can see here. And unless we can escape back up, then I'm still going to be relatively a seller of silver rather than a buyer. Okay. Oil has been one of those trades where we've done 17, count them, 17 trades in a row, going back to October timeframe of last year, where we've been successful in the oil markets. And you can see this downsloping trend line. We've been playing oil in each one of these runs, both up and down, until we broke out right here. I was bearish and we shifted bullish. We're leaning bullish now in our strategies. I said oil would run up and then find resistance right at this area here, right around 52, and that's exactly what we've got right now. I think oil is going to go now into more of a sideways chop pattern, and then we'll wait to see which way it wants to break out. I think there's some limited upside movement limited downside movement, so we're going to continue our strategy in the oil market. And then looking at agriculture, meats and softs, there are trades that I'm watching, but the setup is just not there yet. So for our members, just stand down until we get something going. All right, everybody, that is our weekly update brought to you by our Trader User Group. Be on the lookout for an email coming up. Our Option Masters education series is something you definitely want to be a part of, so check it out when it hits your inbox Monday or Tuesday of this coming week. Otherwise, everybody have a great weekend, and I will be in touch. Ciao, folks.